Now let's actually talk about charts and indicators. So charts actually come in a different couple of formats, and you can actually take advantage of some. Now the first would be a line, and it's just a solid line that goes up and down, monitoring current market price for that Forex pair or commodities such as gold, NASDAQ 500, or the US 30. Now when you actually talk about the second type of format, that's actually going towards a hollow body bar. That's basically just a candlestick that's hollow, just showing the opening and closing price of that certain time frame. Moving on to the third type would be the candlestick. Now the candlestick is the most popular because it's used by all Forex traders because it actually shows a color and also price reactivity depending on how it closes, and you can actually look for certain types of formations with these candlesticks to tell where price is actually going to be headed. And that's what's actually called price action trading. Now what's different than price action trading would be indicator trading, which can be used in similar or actually differently. Indicators are actually computer robots that are actually on your format of a chart doing all that analysis for you. Now the first type of indicator that you're probably used to hearing is called an RSI, Relative Strength Index. Basically, that's always measuring if price is overbought or oversold. Being at these are at certain levels on a chart, an 80 RSI level is normally telling you that something is overbought, meaning that it is time to sell. And on the other side of the flip, you're going to have an RSI level of a 20 that is telling you something that price is oversold, which is calling for a buy. Those two basic RSI levels can help you out in trading, showing you when you can sell and when you can buy. But it is not solely something you need to rely on. Now, one of the most popular indicators in Forex trading is called an EMA, or an exponential moving average. And basically, in short terms, that's just an average filter of current market price through over time. So what that actually can serve as is either a support and resistance, or something that price reacts off of, or just basically a normal filter showing you the uptrend or the downtrend. Now the third and most common indicator that Forex traders are using is what's called a MACD. A MACD is an oscillating indicator, very, very similar to the RSI. And what it is basically telling the market and also you as a trader that there is some momentum about to be picking up. And when the actual signals cross in the MACD format is a good time to act upon the trade. Now you know about a few different indicators in Forex trading, and normally you use all three of them as one to be able to predict that type of movement and also your trades. Also, now the difference in versus from indicators is going to be price action trading, which is basically what we talked about in the beginning, which is more aligned with looking at candlesticks. And it is actually my preferred way to trade. I do not look at any type of indicators, it's just my style. I solely only rely on the candlesticks and what they're telling me on higher time frames and lower time frames to base my bias on these Forex currency pairs.